Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. The best way to do that is to follow me on X at Focused Compound. All of the information is down in the description below. If you're watching on the screen right now, this is focuscompounding.com, where you can get access to archives by Geoff Gannon going all the way back to 2005. All sorts of investment write-ups on topics, different stocks, basically anything under the sun that you could think of as it relates to value investing. And yes, I am going to claim that. So be sure to go to Focus Compounding and you can get all of that for free. So in today's podcast, we are going to continue on with our Outsider series. And we're on chapter 4. If you're just tuning in for the first time and you want to get access to past episodes, you'll have to scroll back a few episodes to get 1 through 3. But this is on John Malone, this chapter. And I think this is probably the most amount of underlines and notes that I've had so far out of this book. Okay. Love learning about John Malone. Have read Cable Cowboy. You've read Cable Cowboy. Yes. It's back in print. We talked about that a few podcasts ago, so you can get access to that by going to Amazon and buying it. My biggest takeaway from John Malone is, and I keep reusing this word, Geoff, he's a systems guy. He's a systems thinker. He puts the right processes in place. He has a framework, a very simple framework, but it's also very complicated, but very simple from the perspective of what he's setting out to do, and he follows it. Very disciplined person in how he runs his business. This chapter talked about he walked away from a deal once because the price was $1 million over what he wanted to pay. At that scale, when he was, already generating hundreds of millions in cash flow, it shows how diligent he is in his deal making. But that's basically how I would describe John Malone, a systems guy that's very focused on deal making. So chapter 4, he was the CEO of TCI. They were in the cable television business, and he goes over essentially what caught his attention on why he wanted to go into the cable television business on page 83. He said that the business was highly predictable. It had a utility-like revenue stream. And then, of course, if you know John Malone, you know this, it came with favorable tax characteristics. And then, of course, the fact that from a macro perspective, the industry was growing like a weed. Online, you could find a talk that he gave to, I think it was a corporate finance class. It was 2 hours long. He sits there and talks to him about his story. And I believe he used the word tax like a bajillion times in that talk. So a guy that's very focused on taxes. I think he's the one that said it is your legal right or your legal obligation, something to pay like the only like the amount that you're owed and like not a dollar over that. From reading this chapter, they actually had a corporate tax team that he was the chairman of, or he would chair, and they would meet monthly and talk about creative tax strategies for the company. So yeah, very focused on tax. I think TCI barely generated any sort of GAAP profits throughout his time at the company, but the company did generate a ton of cash flow, and they used a bunch of debt, right? So the idea was the interest was tax deductible, the construction where they would build out stuff was able to be depreciated, and then you would have the cash flow that came off of it. So super interesting guy, obviously incredibly smart, went to Yale, has a PhD, is really just like an engineer, super brilliant guy. So anything that stands out to you about John Malone at the start of his career and getting involved with TCI? And then we could kind of go from there. Want to hear your thoughts on him?
Well, similar to like some other, he's similar to a few that we've talked about, and some we haven't too. But he had a background in consulting. Do you work for McKinsey? He worked for one of the big consulting firms. Yeah,
McKinsey. Yeah.
And he did do work on the AT&T, to explain to AT&T why their cap allocation was bad. Why they should take on a lot of debt and buy back a lot of shares or something like that. And they said that's a bad idea and stuff. So AT&T is like a mature version of what the cable TV stuff would be. He's joining like 15 years after the company's founded or something, at least 15 years. It's founded in the mid 50s, I think. And the character who's running the company is a bit freewheeling, a bit borrowing a lot of money and doing a lot of stuff, and probably doesn't have the discipline in terms of the financial stuff that a John Malone can bring to it. So there's good stuff going on there, but it's in need of some real help, or it could go under if it grows too fast over time. This is a story of rapid growth, similar to Teledyne, that they did it a different way, but it's often very risky, and it has to be carried out by someone who really knows what they're doing. I think the system stuff you talked about is true in terms of like how he thought. So obviously reducing taxes is part of it, but also basically, I don't know, I don't have a quote here in this, but basically what they thought is like, a subscriber is a subscriber is a subscriber, right? Like that's what we're buying here. That's what this is worth. So how cable TV worked in the United States is you would pass these houses, which would allow you to hook up to them the same way you would with like natural gas or something. And so now it made it possible they could be a customer. Like with railroads, there's no point to overbuild, that is to build next to someone else's existing infrastructure to do this. It's very expensive to do, and there wouldn't be much point to introduce a competition. Now, even more so than the railroad stuff, we get into actual communities regulating this. And so there's like some of these franchises come up later, like the New York City one and stuff comes up much later than it probably should have, but that's because New York City kind of dug in their heels and stuff on it and probably wanted to award it to people that would help them politically or whatever. And so you have ones like that over time, there's particularly desirable franchises that maybe people are willing to pay more for subscribers. And his focus was like, let's just get the most subscribers at the lowest possible cost. That's in the long run what will drive things. And we'll drive things for the channels, which is where he personally made his money, his liberty, by arranging for that transaction. And that was a content transaction, but it was possible to do that at a content provider that had all those subs already. And so it was more important to have millions of subs in random places throughout the United States than to have a high concentration of them in Manhattan or something, So don't overpay to have the highest number of subscribers. Value it on a per subscriber basis, value it in terms of EBITDA, all the things that people take for granted that all analysts looking at the company, that the industry would do today. And at many industries, even industries where it makes a lot less sense to think of. I feel like, financial analysts now think of every industry sort of like it's the cable industry in terms of the metrics that they use,
Yeah, I mean, back then, everything was based on EPS. So he was he paved the way of like to think about EBITDA as like a proxy for cash flow and to be valued off of that. And that's one thing that I wrote down in my notes was how independent he was and how he was doing things. So not only from like an actual public company perspective, he was, doing things that other people weren't doing, but also in the industry itself. He was, being a trailblazer and paving his own path. And then, of course, now and then ultimately everyone started following the same metrics that he was talking about. And of course, yes, like you said, everyone kind of talks about companies as if they are telecom. So, yeah, I thought it was pretty interesting from that perspective. He always thought about himself as being a capital allocator and an investor first, right? So very much like the other individuals that we spoke about in this book so far, he would put the right person in place, set the budget, keep people accountable, and then he would, be focusing on deal making, allocating capital, and doing things that were really going to move the needle for the company. He did run the operations for a little bit when they went through a tough time, but as he cut costs, I think he laid off like 2,500 people or whatever, cut costs, freed up some cash. Then he put somebody else back in place so he could get back to focusing on what he liked to do, which was the actual capital allocation process.
Yeah, what you're talking about there was kind of an incident where they put someone in who was more of a business type person, and they kind of made some decisions that quickly snowballed in terms of too much headcount and too much whatever fast. Because this, like Cap Cities and some of the other companies, was always a shoestring type operation from the early days. And so it became a danger once they had enough money and enough credit and everything later on that they could have some bloat, and it bloated really fast. And so you had to come in and take care of that. I think that they hadn't wanted that to appear at the company at all at the beginning, and it hadn't, but then they introduced some changes later that caused that problem. Like you were saying, yep. So it got the kind of CBS thinking instead of Cap Cities thinking.
Yeah. Something that I thought was interesting, and the book hits on this, and I screenshotted it. So it goes over something, if I pronounce this correctly, the edifice complex, where it says that there's an inverse correlation between building fancy headquarters and strong investor returns. So this is on page 88, if you want to look it up. But basically, at the point of when the company was worth billions of dollars, corporate staff was only 17. So they only had 17 people working in corporate, and it was a very shoestring operation, like you had just said. There was an automatic response system when you called in. I think there was, I don't know, maybe a couple of secretaries, but it was very bare bones. I mean, most of the executives were always on the road doing deals. And something that I thought was funny was John Malone had said, we don't believe in staff. Staff are people who second guess others. And I think that's great, because you see that at these big corporations where there's just so much bureaucracy. There's so many people that have to make a single decision, and ultimately nothing gets done. So I think really staying away from that and insulating yourself from that groupthink is super important. And it's a common theme that we're seeing from all of these capital allocators that we're reading about in this book.
Yeah. What happens, though, is in the early days, you can naturally select for that, because who's going to join a company out in the middle of the country on the verge of bankruptcy for anything other than an equity stake in the hope that you'll get a lot of money over time doing that? But by the time you're the biggest cable company in the country, you're attracting the same people who'd otherwise go to work for IBM or US Steel or whatever, because it's a big, comfortable, cushy job and stuff, The people who join Facebook in the first couple of years are not the people who are looking to join 10 years later. 10 years later, it's a blue chip, So they're looking for a secure job and a different type approach entirely. So you have to be more careful about that later.
Yeah. Mm-hmm. To further show just how unique the structures were that he came up with and how much he thought about capital allocation. So this kind of reminded me, on a recent Q&A, somebody had asked us what is the best form of capital allocation we've ever seen a microcap do. And you had talked about Canterbury Park.
Yes.
On page 94, it talked about how he would create JVs, and in return for what they supplied, which were access to TCI's scale advantages, like its subscribers and programming discounts, he got minority stakes in their business. So I just kind of wrote capital light. It just kind of further instilled in me how much he was thinking about what's going to be the best return for our shareholders and how can we best do this from a structure standpoint.
Yeah, and there's a few aspects to that. One is he thinks strategically about the industry. Now, part of that is because, like at Teledyne, like at Cap Cities, for a lot of this time, there's basically a COO or something at the company, so you're not taking care of all that. Or each subsidiary is really run on its own, that they know how to run their local cable operation, right? So you can think about the strategic things, but he's thinking, okay, we've got lots of subscribers and stuff. How do we put these two things together? I need content. They can't successfully launch, and this is a big part of it that's hard to understand today, but was true then. There's no way to launch a channel without enough reach. You need to be in enough homes to launch a channel. And so you had a lot of things that had a lot of the dial to fill. They were reaching much of the country, running cable to them, but they were hungry for content. That's when people would joke that there's 90 channels and nothing on, and then the other side, you have people trying to launch things like Discovery Channel or whatever, and they think they have all this great content that they've secured, all this nature stuff and these documentaries and things, but if they launch in 20 million homes instead of 80 million or something, is the difference between life and death potentially in the first few years as they burn through all their cash and stuff. Because even if everyone who can watch starts watching at high rates, they need everyone to be watching, or they're not going to be able to reach advertisers and stuff to do this. So that's what needed to happen. He knew that. And then the other advantage here is, which is something we talked about with Canterbury Park, The way these things are accounted for and stuff, it's very easy for people not to know the value of them. I saw this when I was reading someone doing a sum of the parts of Paramount. They take, if someone offered a bid for something or someone bought something, then they have a point of reference that they can take that transaction. But when someone says, I'll swap you this for that, right? If no one knows how to value it, if Marvel and Sony say, if Disney and Sony say, okay, to resolve this issue with the Spider-Man rights or something, we'll give you these rights and you give us those rights. It doesn't get put on the books at any value. And so you don't realize that some huge, one of the most valuable assets, like in entertainment or something, was just moved from one thing to another. That was my point with the Canterbury Park, with the land and stuff. You pay a lot of tax and stuff. If you move it into a joint venture doing that, it's a much smarter way of doing it. And on the downside, I guess you could say, maybe people looking at it as a stock don't immediately realize what just happened, how much it might be worth, whatever, because it's not all spelled out for you in dollars. Same thing here, and what would go on with Liberty is what exactly are these joint ventures worth and all of that. It's the same thing when other companies own minority percentages of cable channels and stuff. What are they worth? It's harder to know when you contributed stuff that wasn't just cash. And it's a low risk thing, right? He's increasing the chance that the channel will be successful by putting on his service. And he's decreasing him putting up money that would fail if it fails. So lowers the probability it will fail and lowers the downside, how much he loses when it fails.
From a structure standpoint, so the way that he would structure his debt, the book says that he would do it with great care to lower costs and avoid cross-collateralization, so that if one system defaulted on its debt, it would not affect the credit of the entire company. So this idea of protecting the mothership, no matter what we do.
Well, he was interested in Navy things, right? So he talked about his bulkheads all the time, right? Wasn't that his thing? Yeah. So basically compartments that could flood. It's like defense in depth. There's compartmented defenses so that if something fails, it fails in a limited way instead of failing across the whole thing. It's like in World War I and stuff, at the end of the war, the Germans give up, and they give up because if there's a failure that they see is happening with their line and stuff, the whole thing's going to collapse. There's no way for them to fail in an orderly way here, which is a whole different method of defense, and it works up until the point in which everything collapses. But it's the opposite of when, like look at AIG and stuff. If you remember the AIG story, I think it was the state of Texas told them, the insurance regulator there, we're about to seize one of your subsidiaries on such and such a date. We're not even going to wait for like whether the Fed's going to rescue you or whatever. And that's what really pushed it over, because as soon as one went down, they were all cross-collateralized across other things. AM Best and stuff is going to say, don't take these people's insurance. It's no good. Anything. I mean, they'll just have no credit the next morning if you can't bail out this thing that we're seizing in one small subsidiary that you have, because they were using their good credit rating to kind of speculate with the financial products group or whatever it was called. So this is the opposite of that, where you're saying, okay, if we have a problem in one of these, let's make sure it doesn't take down the entire system.
Yeah.
And a lot of people wouldn't add in that layer of protection, but why not get it when you can negotiate it if it's not a key point for the for your creditors and stuff? And it helps in terms of flexibility of what you can do. It's a good thought to have, but a lot of people wouldn't add it in there to think about that systematically in every negotiation you had.
One big takeaway is his thoughts towards opportunity cost, right? He doesn't come out and say, oh, what's our opportunity cost per se, but you could just tell by the things that he did that he thought long and hard about these things. Reminds me of Henry Singleton that way. So at the bottom of page 100, it says, when it came to issuing equity, Malone was parsimonious with the company's occasional offerings, time to coincide with record high multiples on his stock. So he was very, very conscious of that. Something that I thought was interesting on the next page, page 101, he had told David Wargo that it makes sense to maybe sell off some of our systems at 10 times cash flow to buy back our stock at 7 times. So again, just that concept of opportunity cost and allocating capital and always allocating to where you have the best potential IRR is something that you just know that he thought about, and like actually making the hard decisions of, let's sell off some of this to actually buy back our stock. That doesn't happen at public companies as much unless you have someone like John Malone running the business. And more to that point as well, obviously through their their B shares. They controlled the company. They had like a hard control on the company.
Yeah.
But, he really ran the business like it was his own company. So when you go through and you read about how he thought long and hard about different tax things, what can they do to get the best return, how to allocate capital, to me, I was just like, he's really running this and putting, the level of thoughtfulness into doing these structures as if it was a personal business, that was going to affect him, future generations of his family, and everything like that. When he starts doing the tracking stocks and all this different stuff, I'm like, he's really it, because I feel like most public companies are like, well, that's what the business did, and we'll pay the taxes on it. I'm an employee. Yes, I may own some stock, but whatever. But him, it was like, no, that's not good enough. It's as if this is my personal money, my personal legacy. How are we going to do this in a great way?
And he didn't own that much initially, and he didn't have very hard control of it initially. He behaved like he would get those things eventually, and then he figured out ways to do it. But he wasn't the founder of the company, and if you look at how much he owned early on, not necessarily everyone would think that way, but he was thinking basically, if I make this an incredibly valuable thing, and so they have the chart on page 99. So that is 25 years of the record or something like that. Anyway, it compounded about 30% a year versus 20% for its peers in cable, and the S&P also did really well during that time, obviously.
14%.
14%. So it makes a huge difference, obviously. But if I have a ticket on this thing that's going really fast, that's compounding at this huge rate, I'll figure out a way to get super rich and stuff from it, and that's what he did. Instead of trying to figure out other ways of what a lot of people would do to maximize things in the short term from it in terms of their own compensation and stuff. Just that if you think that way and you can get it to compounding at a much higher rate, then eventually this can solve a lot of our problems. And it did through very high efficiency that way.
Mm-hmm. On page 104, we could go through his acquisition framework. The page goes over, it says, he was also, however, a value buyer, and he quickly developed a simple rule that became the cornerstone of the company's acquisition program. Only purchase companies if the price translated into a maximum multiple of 5 times cash flow after the easily quantifiable benefits from programming discounts and overhead elimination had been realized. This analysis could be done on a single sheet of paper or, if necessary, the back of a napkin. It did not require extensive modeling or projections. What mattered was the quality of the assumptions and the ability to achieve the expected synergies. So I thought that was interesting. And then they actually walked through a company that they took over. It says immediately after TCI took over the floundering Pittsburgh franchise from Warner Communications, it reduced payroll by half, closed the elaborate studios the prior owners had built for the city, and moved headquarters from a downtown skyscraper to a tire warehouse. Within months, the formerly unprofitable system was generating significant cash flow. Kind of reminds me of Tom Murphy that way.
Yes. Yeah. Well, and you use EBITDA to value both of them, and margins don't really matter in them because once you're over a certain point, then you're going to be making lots of money from that. And there's also some similarities in that, like, these are families or whatever people in the community. They may have been overspending in that community specifically to generate goodwill and stuff like that, or because that's, benefits to the family besides that, outside of that. If you're a huge employer there and you're a huge presence and stuff, then you get other things out of it, whereas TCI doesn't care what their standing is in Pittsburgh and whether it's just like any other place to them when they buy it, obviously. So it reminds you a lot of like cap cities that way.
He was opportunistic about buying back their own stock. I think he bought back 40% of the company over time. Something that was interesting that is a common theme from these capital allocators is, which we sort of talked about, but the culture that they put in place. So giving the autonomy to the managers, incentivizing them correctly, controlling the budget, but then giving them the authority to basically go and carry that out and not be on their backs. I put a note saying, wow, because it said in Malone's first 16 years at the helm, not a single senior executive left the company. That's very unusual. 16 years, right? So what does that tell you? That tells you that the culture was probably a pleasant place to work What does that mean? It means they probably had the authority, the autonomy to basically go and do, what they wanted to do, and also were compensated well for that. For
And
retention purposes, that's very important.
We're probably compensating a stock that was compounding at 30% a year. I mean, that's part of the Cap Cities story. Is
that helps.
Cap Cities' only argument for keeping people was basically, we'll give you more freedom to do what you do than other places will, and our stock will go up faster than other people, and that's what your compensation is in and what you'd be losing if you left us. So hopefully those two things matter the most to you. But if base salary and less responsibility matter more to you, then you would leave. I mean, there's no reason why you would stay. It's not like they're feather bedding things that way. So it's not like these places usually paid huge base salaries to people or had large headcount. I mean, remember, I think Tom Murphy actually said in one of the interviews that you mentioned, we ran it probably with less people than we needed all the time, but we made sure that we never ran with more than you needed, which means that each person is carrying more of the weight than you would at other companies. Your job would be split between more people. You'd have more support that way just in terms of higher headcount. All these things are usually very low on headcount. One thing to keep in mind, though, with all the ones we're talking about, Teledyne, not all of them. General Dynamics is totally different. And we've talked about KKR and private equity before. That's totally different. But the ones that we're talking about, and Berkshire, which people know well, it's worth mentioning these things were all created from scratch, or if not scratch, when someone came in the early days. So Tom Murphy at Cap Cities, John Malone here at TCI, very early on to create that culture around one person, basically. It's very different than coming in and trying to change that. And you can see that with what happens at Cap Cities when they take over ABC, another company with a lot of culture in it already in place. Most of these things are taking over something where there's not a culture that is very much the opposite, already strongly in place for years. And that is always the problem that I think in investing, people think there's a lot more good to great stories than built to last stories. And a lot of great companies and a lot of great systems are created from scratch in the early days of the company. And it's a lot harder to unscramble the DNA of what's been built up over time and then reprogramming it into something that it works. A lot of times it's easier to start from scratch because you have to unlearn so much. But these are great ideas for a turnaround. If someone could do that, it's just so hard how you do that. And, you see that come up in some of these ones that is the difficulty, that these are really built around one person's rational thinking on what systems should be in place and stuff.
Got it. Any final thoughts on John Malone? As you had said, at his time at the company, compounded at 30% a year. Obviously one of the best to do it. Yeah. Any final thoughts on John Malone? Any takeaways from your perspective?
Yeah, I mean, look, the industry is, like other media things, different from some other ones. This is not an industry where they necessarily have to care a great deal about customer satisfaction. And so this is also the era where TCI is getting the biggest ever, in which satisfaction with cable is poor, in which politicians are saying we've got to crack down on this and whatever. Probably some of that is what made him want to, my guess, think about like retiring and leaving and stuff. That's just not fun running a company of that size and all those things. And he has a similar end to his story at TCI as you would see with Ted Turner, with Time Warner. He basically decides to, for tax reasons and other things, to do a deal in which he stays on in terms of owning a lot of stock in another company, but it's not a company that's run the way that his company was. And so he kind of gets locked in owning a stock in something where he doesn't have operational control, and it's the wrong kind of culture. So even though he gets a good price, the problem is that at the exit, it's a real problem in terms of what that company looks like in terms of its performance in the years after that. And that is a common thing for these entrepreneurs who are really good at running a certain business. They sell it to someone bigger who's not as good, and they take stock, and they live to regret it.
Yeah, I mean, Malone said, was it Malone or Ted Turner saying that he would never do another deal where he's going to take stock but not have a seat at the table?
That's a good question. My memory is Malone never did do another deal where he didn't do that. I'm trying to think. He's had heavy influence, whether it's like 20% vote, ownership and like very high voting and stuff through the Liberty years and stuff. Yeah, he's been involved. He's been able to name someone to boards and stuff and like everything that he's done basically.
So I skipped over something that I wanted to hit on. How much he thought about free cash flow, right? And just let me read to you. This is on page 102. And this says it relates to CapEx, right? At the bottom, Malone saw no quantifiable benefit to improving his cable infrastructure unless it resulted in new revenues. To him, the math was undeniably clear. If capital expenditures were lower, cash flow would be higher. And then in the next paragraph, it says Malone appreciated how difficult and expensive it was to implement new technologies and preferred to wait and let his peers prove the economic viability of new services, saying of an early 1980s decision to delay the introduction of a new setup box. Let's see. He said, we lost no major ground by waiting to invest. Unfortunately, pioneers in the cable technology often have arrows in their backs. TCI was the last public company to introduce pay-per-view programming, and when it did, Malone convinced the programmers to help pay for the equipment. So again, basically waiting for some sort of proven technology before he would lay out that capital from like a CapEx perspective. So again, he's not like trying to pave the way from like an innovation perspective. He was very focused on free cash flow and, not basically sinking all of that cash flow into capital expenditures, which you do see very often in a lot of companies.
Yeah, and his thing was whether it proves whether there'd be revenue coming in. And in the long run, I think he was right. Because if you look, these interactive set-top boxes and things, it would be like 15 years before people would be using this from the earliest days of when they're trying to get it in a way that probably generated a lot of revenue for the cable companies. What people wanted was lots of high-quality programming, a diverse set of all sorts of high-quality programming. And by being the biggest cable company and signing deals with all these things, he was able to deliver that. If it was antiquated set-top boxes and poor quality in many ways in terms of the infrastructure and the technology, and it was low-tech, but it was delivering them what they wanted. If they had BET and MTV and whatever out in whatever random place they were in, and there was always something on, that's what they cared a lot more about and were willing to pay for. And so I don't think he was against investing in things that drove additional revenue, but there's always an aspect to the industry like this where there's technology people are interested, well, we can do this, so let's do this technology. If anything, remembering the days of cable, I think that a lot of times changing things up with the technology was stuff that was a negative for the consumer. Consumers never understood the technology of cable very well, or the set-top boxes and things. And I know it's hard to believe today since the smartphone era, but before things were as intuitive as that, introducing a lot better technology to people that could do a lot more things, it was not always the best decision because people were confused and intimidated by the set-top boxes in their homes, as opposed to when they could just have a cable coming into the house and hooking up to something that way. And sure, some people knew how to use it and what it was good for, but most other people just wanted to know what channel the thing that they wanted to see was on and that they could find it somewhere. They would take their little TV guide, open it up, and they wanted to know that they got that channel and then that thing was there. And that's what they cared about. These things were not super intuitive for many, many years. So when they're pushing it as the new high-tech thing, literally it's a decade and a half until your average person could be using it, and longer till your grandma and stuff would be able to know how to navigate this stuff. So it's not a bad idea to not be introducing this into everybody's home just because we're capable of doing it.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focused Compounding Podcast. We will continue on with our Outsider series. Who do we have next? Let's see. Who is it? Is it Catherine Graham and the Washington Post Company, Chapter 5. So if you want to pre-read that, definitely do that. Be on the lookout for that here soon. I want to thank everybody so much for tuning in with the both of us on the Focused Compounding Podcast. Be sure to hit the subscribe button wherever you are listening or watching us here today. If you're interested in learning about our money management services, you can reach out to me at andrew@focusedcompounding.com. I want to thank everybody so much for all the support, and we will see you in the next podcast. Take care.